Pending home sales data just released and it was ugly yet again. Home sales are at 2008 GFC lows, but yet home prices just hit an all time high. What is happening in the housing market? There's been some eco data in the past couple days I think is notable. So we have new home sales and existing home sales both come in below expectations, which is this middle column here. New homes came in 627K, expectation was 645K. Existing home sales that came in at 3.93. The expectation was 4 million. We also had PMIs come in, at least services PMI come in much hotter than the expectation was 55.2. Now, remember with PMI, Managers Index, anything above 50 is expansionary in a business cycle sense. Anything below 50 is contractionary. The expectation was 53.2. We came in well above that 55.2, indicating expansion in the services sector of the US economy. Manufacturing, on the other hand, came in significantly below expectation at 49.5, and the expectation was 52.7. So in addition to that, we had initial jobless claims. Those came in 217,000. And there's something interesting happening in the labor market that I think is worth pointing out from a macro point of view. So here's initial claims. We can see that, going back to 2021, during the height of all that, initial claims and continuing claims, the labor market was severely dislocated and has been recovering ever since. Well, if we go back to 2022, initial claims are basically flat. So, you'll see a month or two where there's kind of a pop in the number of initial jobless claims, but in general, it's sideways. Now, if we look at continuing claims, which is here in red, continuing claims are in much more of a pronounced uptrend. And in fact, we've kind of taken a leg higher here over the past quarter, where we've seen continuing claims, which set a bottom back in May of 2022 and have been headed higher ever since. Not only that, but we can look at the average weeks unemployed. This data is a little behind continuing claims data, but we can see the same trend with this. This has been trending higher. So what this is indicating is that the number of terminations, at least initially, is not surging. The problem is that those that have been fired in the past couple of years are staying unemployed longer. It's harder for them to find a new job. This is a tightening of the labor market. But the fact that initial claims are not surging, continuing claims, clearly has an impact on something like the unemployment rate. But all of this together indicates a normalization of the labor market. Now, there's a couple of caveats here. So, with some of this labor market data, it's a little bit broken because, for example, in some states, unemployment per week is like $450. And that's not enough to survive. That hasn't been increased in many years. And it's not enough to survive. So what people will do, instead of filing for unemployment, they will just go work for DoorDash. They'll go work for Uber, this gig work. So this is something Mike Green talks about and has been talking about, that a lot of these labor market metrics are a little bit broken just because of the new economy or the new structure of the economy. So it is likely even worse than this. And this is one of the reasons we emphasize the U6 unemployment rate versus, say, the headline unemployment rate. Now, getting to the housing market and the concept of liquidity and transaction, determining price and all of this. Here's existing home sales in white. We did a video on in depth the housing market and why it will probably only get worse. That's been our view going back to 2023. It was very contrarian at the time, very contrarian, but it is proven correct. We've seen home prices continue to set new all-time highs. Every year, they're just going higher and higher and higher. But if we look at the transaction number, right, the number of homes actually being sold, it's at the same level going back in February of 2009, in the height of the GFC, in the very the height of the great financial crisis, 2008, housing market collapse, right? Well, home sales are at the same exact level that they were back in the height of the GFC. So what's going on? One of the reasons that it was there's so many housing bears were saying that home prices would crash was because of transactions. And they would post charts showing correlations of home price to these transactions, transaction number, volume, and show that correlation. Say, look, the number of homes, being transacted is falling off a cliff. Therefore, home prices must fall. Well, that might have been true in a healthy market environment, but we are not in a healthy market environment. We are in a broken market, and one of the ways that I think this is best illustrated is here is home sales divided by, or excuse me, price home price divided by sales. And so remember with these relative charts, what they indicate, if the numerator is increasing faster than the denominator, this line will go up. And so by taking this ratio, we can see that they basically went flat. What this means is that if the price went up, sales were probably going up. And if the price was coming down, sales were probably coming down. And it was that way from 82 all the way up until the GFC. Leading into the housing bubble, of course, it started to dislocate here. We can see where price started to run away from sales. And sure enough, that's exactly what we've seen going back to 2020, really. Home price has greatly outpaced the actual number of sales. And so this gets to that kind of broken environment that I'm mentioning. And one of the other ways to measure this, by the way, here's a month over month change of home sales. We can see 2.7%. Home sales contracted at 2.7% compared to last month. Monthly data has a lot of noise in it, as you can see, so not the most useful. One of the other components here is as to why this is happening. So we'll get into liquidity and market dynamics, market mechanics in a second here. But one of the other really critical points that I think a lot of people are missing is the degree of degree to which the rich are stepping in, the degree to which the wealthy are stepping in. To prop up the housing market and to keep home prices high. So this is one way of illustrating that. And we looked at this, in the housing video as well. But the average mortgage size has been declining, and yet that the single family home price has been increasing. So we've never really seen that going back all the way to the 90s. We've never really seen that where they are diverging completely. Now, in a housing market, in a housing bull market, you will see the single family home price increase faster than the average mortgage size. And, both are increasing, but the home price is increasing faster. And again, this makes sense in a housing bull market where, everyone wants to buy housing. Cash buyers and the wealthy will step in during a bull market, bid up the value of the home, right? Home price, taking that number higher. But because they're cash buyers, you won't see a coincident rise in the mortgage size. The mortgage size is the everyday person that needs to finance a $500,000 house, but a cash buyer, a millionaire, someone worth $55 million, they might just pay cash. And so this is why you see the single family home price accelerate faster than the average mortgage size during a housing bull market. But we've never seen, really, at least as far back as this data goes, we've never seen the mortgage size in a 3-year decline, but yet the single family home price in a 3-year uptrend. So that divergence, what it is indicating is the degree to which cash buyers are stepping in. Sure, during a bull market, you might see it to some degree, but you've never seen it go in opposite directions. So again, this just gets to the point of the degree to which these wealthy cash buyers are stepping in and not needing a mortgage and just buying it in cash. The K-shaped economy is very real. We've been talking about this bifurcated economy. It's one of the biggest issues of our time. Wealth inequality worse than the Gilded Age, and all these dynamics. Well, this is it. This is those dynamics in action. The housing market is a perfect illustration of what can happen in that sort of environment with a K-shaped economy. The average 32-year-old that just wants to buy a house, start a family, have a kid, live the American dream. Well, yeah, totally. They are out of luck. They are totally priced out and they're just out of luck, but it doesn't matter. And this is what I was trying to say. Unfortunately, I am that person. I am that 32-year-old wishing to buy a house. So, it matters personally, but when I try to do analysis, I need to look at it objectively. And unfortunately, for the past couple years, I've seen it playing out this way. And sure enough, that's how it's played out, where the wealthy and the cash buyers are stepping in to keep home prices high, actually not even constant, but moving higher. And meanwhile, the average mortgage size is coming down. The average person that used to, you used to use these metrics of, say, transactions to determine the home price. Well, you can't. It's a different environment. It's a broken environment where we have the price running just utterly away from the actual number of sales. So what this indicates is a low liquidity environment, and this is a market mechanics sort of thing. And I'm not sure how many followers are market participants, but I wanted to try to illustrate market mechanics here. So here is an order book for a SPY put option. I believe this was at the money. And what we can see over here are the bids, right? These are people that have an order. They put an order in to buy this options contract. And the fact that it's an option doesn't really matter. You could think of this as shares if that's simpler. I understand options are complicated, so you can just think of this as shares. It's really the same dynamic, which is you have 89 bids at 48 cents. People are willing to pay 48 cents per contract for this particular strike. There's 89 of those bids. Down here, through a different exchange, there's 80 bids at the same price, right? And you go down the list and you can see this is a relatively healthy liquidity environment. You can see the bid-ask spread, which is one way to measure what's called liquidity, is very tight, right? The difference between the bid and the asking price or the selling price there essentially is just 1 cent. It could not be lower than it is, because at least in markets they go in 1 cent increments. So it's as tight as it can get. Well, when the bid ask spread, the difference between what are buyers willing to pay versus what are sellers trying to sell for, when that difference, when the gap between those two numbers is low, tight, that represents a high liquidity environment or a positive liquidity environment. Now here is a different order book. So this is a options contract, I think, on Coca-Cola, and here you can see a totally different dynamic. So with this one, you can see that the bid is $5.40. That is the highest bid in the entire order book for this particular options contract, $5.40. If you go to the ask, it's $6. So that is a 60 cent difference between what is the lowest price that someone is willing to sell the option for versus what is the highest price that someone is willing to pay. This is called a spread. And we can see that the spread represents 10%, right? It's 60 cents. That represents 10% of the asking price, the lowest asking price. So when the gap here is wide, and we can see it even more pronounced down here, when the difference between when the bid ask spread is high, that indicates low liquidity. But this options contract might be trading at, say, 550. Maybe that was the last transaction. But if I really wanted to buy this particular Coca-Cola options contract, and I just wanted to make sure that I would get filled on that position immediately, I would have to pay $6. But if I do pay $6, I can only buy one contract. You can see the number of total bids and the number of people are trying to sell. I could buy just one options contract at $6, and the price would go from 550, right, which is where it is right now. If I if I just buy one of them for $6, the price for all of these, for all the contracts, right? People might hold thousands of these contracts already. The price immediately went up by 50 cents. And so this is the impact. This is the same dynamic with, say, a penny stock. You look at a very, very high liquidity like SPY or QQQ, the bid ask spread is going to be basically nothing. But if you look at a low liquidity, a high bid ask spread, like in a penny stock, for example, where there's not much transactions happening, the spread will be wider, as we can see here. But again, All it takes is one person to come in and buy this particular share or contract or whatever it is, coming in and just really want to get into that position. They're if they're willing to pay $6, well, the price just went from 550 all the way up to $6, and it happened on just one transaction. So when you have a low liquidity environment, a high bid ask spread, and sure enough, this is what we see. I don't have a chart to show it, but if there are charts floating around that show the difference in the housing market between what people are trying to get for their house and what buyers are willing to pay is widening, just like we see with this low liquidity Coca-Cola options contract. But again, it's no different if it's an options contract, a share, or a house. All it takes is someone coming in and willing to pay this higher price, right? It might be trading at say 550, but if someone is coming in and really wants to get into this particular options contract and willing to pay $6, boom, all the thousands of people that hold this particular contract, they just that contract just shot up in value, shot up by 50 cents in a single transaction. So the housing market is really no different. You cannot, if you are in a low liquidity environment, you cannot look to the transaction number, right? How many homes are actually changing hands? You can't look to that. It's just it's a low liquidity environment, and it's not the average kind of home market where you have young people trying to start a family, get a mortgage. We know that's not true because we see here, the single family home prices going up while you have the average mortgage size going down. So we clearly don't have the kind of old dynamic of, the middle class, starting a family and the whole thing. We clearly don't have that, as we can see from this chart. And we also can look at the transactions and see that they are coming in very, very low. They are coming in at the same level that the housing market was seeing in early 2009, as kind of the last time we really saw a true bear market in housing. And yet home prices are going higher. So, it's a liquidity story. It's a bid ask story. It's a market mechanics story. All it takes is some wealthy person really wanting to buy a house in a particular neighborhood. As soon as they pay, say, $435,000 for that home, all the homes around them suddenly shoot up in value, right? Because housing is really no different than the options contract we're looking at here. People out there might be tens of thousands of people that hold the particular Coca-Cola option, right? And they're looking at their brokerage right now and it's showing 550. So, they might be in profit, might be in loss. All it takes is one person coming in and willing to pay $6, and all of those tens of thousands of people that already held this particular options contract, the value suddenly shot up. But now, if they all tried to sell at say $6, right? Because now their brokerage will be show. If I step in right the second, pay $6, all of their brokerage accounts are going to show, okay, the going price is $6. So they just made a huge gain basically off no activity. Now, if they all tried to sell, it's a different story, right? But the point is that data doesn't work that way. The point is that housing is priced. We're looking at the data of the last transaction, the last marginal transaction. And so it doesn't really matter if the volume is super low. In a low liquidity environment, you will get dynamics getting stretched, as we could see from looking at price divided by sales. We can see that this is really reaching levels never seen before. It's just gone straight vertical. It's doubled, right? I'm not sure what the ratio. Yeah, so the ratio went from a 0.05 to 0.11. So it doubled. And we can see, during the late 70s, there was also quite a run up, and of course, inevitable recession. It came back down and was basically range bound, except going into the housing bubble in 2005, 2006. We can see it started to run away. But we have been in a 5-year a vertical uptrend in this particular metric where where home prices are appreciating faster than the number of transactions. And again, this is just what happens in a low liquidity environment. There are not a ton of housing units changing hands, but there don't need to be. All that matters is that the wealthy, who we know have never been wealthier, the wealthy are willing to pay the asking price. And even though there might be a high spread, a high difference, a low liquidity environment, a high bid ask spread, even though there might be a higher spread, if someone is willing to come in and pay $6, boom, all the houses in that neighborhood, are now worth that new higher price. Now again, if all of those people try to sell into what we established as a very low liquidity environment, the story would be a lot different. But we don't have a ton of forced home sellers. As we were looking at with initial jobless claims and the unemployment rate, there is really no catalyst for that. And so here, just to finish up, this was the post that I was referring to, March 13th, 2024. Volume does not matter in a broken environment, whether it's record unaffordability in housing or a penny stock with awful liquidity and a high bid ask spread. And so I tried to answer the question everyone was asking, which is, who will buy all these houses? Well, I said, it will be the rich, like it always is. The top 1% alone, just the top 1% own $58 trillion in wealth. The top 10% own $150 trillion in wealth. If you take the total single family homes bought and sold in a year, and this is actually higher than the current transactions are, right? We know it's 4 million. But even using this higher average of 5 million single family homes bought and sold each year, uh, the total value transacted with those 5 million homes works out to about $3 trillion per year. If you take all the home transactions, add up the value of all of them, it's about $3 trillion per year. So at a median cost higher than what it was at the time and higher than what it even is now, median cost of $600,000. So assuming a 50%, I think now it'd be closer to like 35%, assuming a 35% premium to the current price, right? A higher price than we're seeing and a higher transaction volume than we're seeing. Even assuming, that the bull market continues, the top 1% alone could purchase every single family home. They could purchase the entire single family home market each and every year for 20 years. The top 10%, well, they can purchase each and every home sold in the US for 50 years. Now, again, remember, this is assuming that there are more transactions than there actually are. It's also assuming a 50, today, probably like 30% premium on the home price. If you calculate this out, at what the homes are going for, the average home today, it'd probably be like 25 years that the top 1% alone could basically continue to prop up the entire single family home market. Because remember, if you live down the street, someone down the street from you is selling their house, all that matters for your home value, going back to the liquidity example that we were looking at, all that matters for your Zillow estimate, right? What your home is worth is what that home down the street sold for. And if someone was willing to come in and pay whatever the asking price was because it's a low liquidity environment, then, everyone's home on that street just shot up in value. Now, again, it's important to caveat that if they all try to sell into a low liquidity environment, they would not all get, say, $6 per options contract, right? Because there was only one guy willing to buy one contract at that price. So it's not actually the fair market value. It technically is, right? Technically speaking, that is the fair market value at that time because someone was willing to pay it at that time. But really, it's not actually the fair market value because no one else is willing to buy it at that price. So all it really takes is someone else coming in behind to pay an even higher price. And this is just a simple market mechanics thing, and it's disconnected clearly from historical averages. But this is how it is, and this is why it's happening. And I don't personally see any sign of reversal. I don't see a sign of a catalyst for forced sales that will turn a bunch of sellers, right, and actually bring it down to the fair market value. I don't see what that catalyst could possibly be. Now, if you think that the unemployment rate is going to skyrocket, initial claims are going to 500,000, then sure, that might be your catalyst to get the number of transactions to pick up, and therefore to maybe get a correction in the national home price average. But absent that sort of catalyst, this is part of the reason I just don't see home prices going down in a material way, at least on a national average perspective. So, anyways, hopefully that was helpful and a little intro into market mechanics. And yeah, I will catch you in the next one.